Staff bonuses, are they worth it? Are they a good thing? They seem like they can be an incentive, but also a disincentive. And so I'm slightly on the fence about staff bonuses, especially the old, traditional Christmas bonus, etc., but all
Yep.
performance-based bonuses. What's your opinion as an accountant?
Yeah, look, firstly, commercially, not just the tax side, bonuses should be used to modify human behaviour. So the obvious question is, what are you trying to modify? If you're rewarding senior people to bring in sales, great. If it's determined based on profit, like gross profit or net profit, great, but very clear on what that is. If you're going to introduce them over a quarterly cycle versus over an annual cycle, be very, very careful from my experience of rewarding quarterly when you get to the end of the year and you've overpaid for the first couple of quarters and then you can't ask any of it back in the last 2 quarters. What happens if you to also incentivize people to stay with your business is another one. People are just rewarded by short-term carrots. Just be mindful that is there an opportunity to build in some loyalty with some of your team with bonuses where it is actually accrued and paid at the end of the year. So you stay for a year, you get it. If you leave within that time, you get nothing. Sure. So we've had some good experiences with some incentive schemes we put in place. But so far as tax side of things, look, it's employee bonuses are still taxable like other salaries, wages and salaries to employees. It's still a good thing to incentivize your people. You want them to earn, and if there are quarterly, which then hits their payroll, their taxes, they go superannuation's payable on bonuses as well. If you are paying it annually, there is an opportunity for a business owner to potentially accrue a bonus at the end of the year. But the employee doesn't pay tax on it until they physically receive it. So it might fall into the payroll in July or August after year end. So, and that might be good if you've had a good year and you're wanting to accrue the costs and align the cost or the bonuses in that year it relates to in that year. But the employee could actually have it pushed into the next year. So hopefully they don't leave in August or September.
Yeah, and really stuff you.
And but that's another thing.
I guess on the back of bonuses, I've thought about giving some key employees shares in my businesses, but at the same time, I probably don't want them to have control or voting rights, and I'm concerned about that. Is there just one type of share I can give them, or are there multiple types of shares, or I've heard of divisions or levels of shares. What are they?
Yeah, ordinarily you'll have ordinary shares in a business that typically would rank with all other shareholders. There are different classes of shares. You can either set up on the creation of the business or add in time. Got to be a little bit careful with changing the value of underlying shares by adding them later. But there's probably more formal answer you see in a corporate realm is registered employee share acquisition schemes, where you actually set up a scheme where you can issue staff with shares in the company. So the shares that are issued, they are paid for out of bonuses, essentially. So there are still tax consequences, but there's some carve outs for amounts under $1,000 that have some discounts. You can either basically pay tax on it when you get them, or pay tax on it when you go to sell them. Right. Won't go into any more detail on that today, but certainly employee share schemes are probably the most common.
Yeah. And so what's the difference then between a Class A, Class B, Class C, and does it just keep going all the way to Z?
Yeah, well, if you ever pull out a constitution for a company, it's a little bit of late night reading, about 50 pages over a glass of red. But traditionally you'll have what's called redeemable and non-redeemable shares. Really the main classes are whether they have a right to vote, a right to dividends, or a right to capital if the company's ever wound up. So, look, I think if you're talking about incentives or employee bonuses, traditionally for smaller businesses, you'll tend to want to allow people to become a shareholder, whether they take bonuses in the form of getting shares issued, and they become an ordinary shareholder like everybody else. That's probably more common. Traditionally, we also see people who have been in a business for a long period of time, and there's the opportunity for them to be a part owner. where they might be allowed to buy into the business, but they might be offered a discount on the purchase of the shares, 10, 15%, something like that, just purely as an incentive for them to stay and buy in. So they're not necessarily bonuses, they're just incentives for people to transition and come as a part owner. And it's very common in the US. You'll have multiple small businesses that have got maybe 10, 15 different owners where they'll buy in. They might only own 20 to 40% of the company, but they feel a part of the game, and it's they're part of their sweat equity as well.
Yeah, as they say, they got skin in the game.
Skin in the game.
Skin in the game.
Big fan of hard dollars,
hard earned skin in the game.
You pay attention when you got money on the line.
When it's your own money, 100%. Yeah. I guess on that, not so long ago, I was thinking of investing in a business to take a larger stake, but not a controlling stake, so 49%, 51 to the existing owner. And he proposed to me that initially we just did a convertible note. For the people that are watching, what's a convertible note?
Yeah, so essentially it's a loan that can become shares. Right. So typically, again, without going to legal advice or providing specific advice to people listening, it's essentially a loan. It typically attracts an interest rate, so interest is paid. It'll have what's called an exercise date, where after a period of time, that loan can be converted into shares. So if typically interest is added, so that, and obviously the company will have to go up in value, and the share price will go up in value. It's one way at least for the owners or people putting in money in the shorter term to go, you know what, this isn't going as well as I thought it would. I'll take my money back, thanks. So you might rank as a loan holder, secured or unsecured loan holder, where you can get your money back out. Okay. Versus once you become convert it to shares and you become a shareholder, that's hard equity. And
you're kind of stuck.
I've sat in on an online creditors meeting this morning with a number of people who they're obviously creditors, but where you've got stakeholders who are shareholders in the business. And they rank at the bottom so far as their rights and entitlements, compared to secured and unsecured.
The creditors, you mean, rank at the bottom?
Yeah, secured at the top, unsecured. The owners, the equity holders, rank at the bottom. Right. So they get paid last. So, and that's the risk, I suppose, you take by buying a business, say $1 million, and you issue shares to the value of $1 million. Essentially, that's your cost base on the business. So when you go to sell anything more than $1 million, it's obviously capital gain. But typically, convertible notes or loans are used essentially just to loan the business money to assess whether it's going to be successful year or two down the track. And hopefully hit some milestones where those loans will be converted into shares.
Okay.